All done. All silent. Going. Gone. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Welcome to Current Market Insights. Peter O'Malley, absolute pleasure to have you in the studio with me today.
Oh, thanks, Ciaran. Great to see you.
Great to see you, my friend. Look, it's been a big week. RBA's announced another decision on interest rates. Can you tell us a little bit about what's happened and what Governor Lowe has decided to do?
He has increased the interest rates, as we all know now. I think one of the major decisions that we're feeding into his decision to increase interest rates is the fact that property markets are rising around the country. Rising property markets when inflation is high is a real issue for central banks because it allows people to look at the option of refinancing against the extra equity in their property and allowing them to continue their lifestyles as they were, meaning that inflation is likely to persist for longer. So as we're now seeing, taming inflation is nigh on impossible, and unfortunately, central banks need to crush inflation, and there will be many people that are negatively impacted by the Tuesday decision and possibly further decisions into the future.
You've mentioned before, when we've spoken about this issue, we've spoken about interest rates, this idea of the mortgage cliff. It's been in the media. It's kind of been, touched on by a number of people, including yourself, as I said. Do you think that this rise is enough to nudge people over that cliff now?
Well, when you look at a graph of the mortgage cliff and when home loan rates are expiring, those expirations are happening in May, June, July, August 2023 in earnest. That's when the majority of the home loans will expire from their COVID to 2.2% home loans to the current market rate now, which is going to be over 6% in many instances. We've seen in the marketplace a lot of people have recalibrated their affairs well before now to try and avoid the biggest impact of the mortgage cliff, and probably the most discernible trend that we've seen in recent times, Ciaran, is investors selling off investment properties and moving the freed up equity across from the investment property onto their home loan at settlement. And that's allowed those people to maintain lifestyle and get debt levels down. But as we're seeing, is it's not moving inflation to the degree that the central bank would like.
So excluding investors who, as you say, are selling down assets to try and just shore up their equity position, how is the average punter surviving through these rate rises? Cost of living for all of us is going up incredibly fast, or it feels like it is anyway. How are people paying their mortgage and not losing, if they're not going over the cliff, how are they not losing their primary asset?
Well, to help offset, nothing is in totality, Ciaran, but to help offset higher mortgage costs, we're seeing investors increase rents, as we've heard a lot about this year, and we're seeing owner-occupiers maybe take a second job, ask for a pay rise, apply for a new job. Thankfully, the employment market is still pretty good out there. Additionally, people are cutting back on expenditure. So if you move about the town on a Saturday night, you'll notice that it's not as busy as it might otherwise be because people are playing it fairly conservative. And over time, that becomes harder for people to continue living a reduced lifestyle. But certainly, we have not seen massive signs of ultimate distress where people's primary residence have been sold off under duress and mortgagee sales. That's being held at bay at the moment. Long may it last. That's the sort of market reaction that property bears were looking for heading into the mortgage cliff, but thankfully hasn't taken shape to date.
I'm interested to get your take on how the current market looks from a serviceability perspective. You've mentioned before, obviously banks assess people's ability to borrow with a serviceability buffer to make sure that people can pay back those loans. Given that a whole bunch of people would have borrowed at those COVID rates of 2%, 1.88, I've heard in some cases, they would have been assessed at a much lower serviceability ceiling than we potentially face now. I guess in reality, what is happening for those people who are assessed at really low rates?
The way that interest rates have risen, the interest rate of the day has blown past the serviceability rate. So during 2021, when the property market was flying, the serviceability rate imposed by APRA on the retail banks was 2.5% above market rate. So you said that you heard of people getting a mortgage rate of
A 1.88?
1.88%. So add 2.5% to that. And even though they could take a home loan from ANZ or Westpac at 1.88%, ANZ or Westpac or whoever the institution was assessed them at 1.88% plus 2.5%, that being the serviceability rate. As we came out of lockdown in October 2021, to help slow the rampant property market down, APRA then said to the retail banks, we want you to increase the serviceability rate from 2.5% to 3%. And that was the official end, or the unofficial end, I should say, of the property boom. Now, the end of a boom does not signal the start of a crash. The end of the boom means that the rampant price rises that were occurring at that time ceased in about October, November 2021, as lockdown was over and people had to be assessed on a serviceability rate 3%, a full 3% above the mortgage rate of the day. As we know, fast forward to May 2022, we saw the first interest rate rise, and today was the 12th or 13th?
12th, I think.
12th, yeah. Rate rise in that time. So the market has really been grappling with higher mortgage costs in that time, but coming out of COVID, we kept getting told that households had record household savings, and it's fair to say that in many instances those savings have been tipped back into the mortgage and tipped back into subsidising people's cost of living. And if these high interest rates are sustained where we are at the moment, that's going to continue to put pressure on household budgets.
Absolutely. I'm interested, sticking with this serviceability buffer. So APRA, being the prudential regulator, implemented a 3% buffer, as you mentioned. Is that still in effect today, that 3% buffer?
It's still in effect today. So with a mortgage rate now of maybe...
Let's say 6% for argument's sake.
So you're being assessed, can you afford this loan at 9%?
And do you think, let's be honest, how many people can afford a loan at 9% in the Sydney property market right now?
Well, if they've been in the market for a couple of decades, they've got a lot of equity behind them, so the amount of the home loan that they're taking is not excessive. The other thing that home buyers will tell you at the moment is there's just no stock. So whilst there's been a lot of buyers drop out of the property market due to the increasing interest rates, there's even more sellers that have dropped out of going to market, meaning that buyer demand is outstripping seller supply. So how many people are really impacted on this and what's the true impact on the property market? We don't know whilst ever supply is underservicing demand, which is where we're at the moment. And that's the great masking agent as to what's really going on below the surface, Ciaran, because if supply was higher than demand in Sydney, the distressed sellers would become very evident for one and all. But if you're a distressed seller at the moment, the good news for you is you'll be able to hide that element because you've got no seller competition when you do come to market. When you're if and when you're a distressed seller, financial distress, and you're going on the market competing against a lot of other financially distressed sellers, that's when there's big trouble in Little China. That is not happening in the Australian property markets at the moment, thankfully.
You mentioned there that, if you've been in the property market for a couple of decades, you've obviously got some equity built up. Does that mean, let's look at the other end of the spectrum?
That's in the Sydney property market, I said, because if we go to markets like Brisbane, they had 10 years where Brisbane didn't go anywhere. If you're in Perth, you're probably still behind. So it's the Sydney property market where there's this build-up of wealth.
Well, sticking with Sydney then, obviously that wealth, you could argue, is somewhat distributed towards the older generations, right? So for first-home buyers trying to come into the market being assessed with a serviceability buffer of, let's say, 9 or 10% total, an interest rate of 9 or 10%, surely there's not many people out there that can afford to get into the market for their first home with interest rates where they are right now.
Depends what price point they're buying at, and it depends what their earnings are. And it depends what size deposit they come into it. So being assessed on 9% mortgage rate on a $300,000 loan, is a lot different to being assessed on a mortgage rate of 9% on $1 million loan. So it all comes down to what does the first home buyer bring to the table from the bank's perspective as collateral.
Yeah, look, absolutely. I think it's hard to argue, though, that it isn't a difficult time for people trying to get into the market for the first time.
There's no easy decisions out there because it's difficult being a tenant and it's difficult being a purchaser. So what that means, a purchaser trying to get on the property ladder, once you're on the ladder. So another way to describe it is those people that have been, whether they're young or old, I'm not buying into, but if they've been in the property market for 10, 15 years, they've built up equity, so they're well up on the property ladder. So they're just trading up and down the ladder, but with reduced debt levels. But if you are a young person trying to get onto the property ladder in Sydney, absolutely, it's difficult.
It's a tough time. Look, I want to speculate a little bit, if I can, from here. One of the reasons I believe that the Reserve Bank decided to increase rates again was inflation is holding at 7%, I think was the
6.8, yep.
6.8, yep. So from here, let's assume next month or through the end of this month, inflation holds where it is. What does the RBA do from here? Because surely they must be thinking of some other levers or mechanisms that can be implemented across the market or other strategies to try and peg inflation back.
Well, it should be noted that consumer confidence has crashed. I read somewhere from an ANZ Roy Morgan survey. It's crashed to its lowest level, I think, since December 1990.
1990, yeah, I read that as well.
So that's pretty dire, and that's showing us that people are cutting back on their cost of living and discretionary income out there as a way of fighting off these higher mortgage costs. The way central banks assess things, they don't look at consumer confidence. They will unfortunately be looking at things like unemployment rates, which are still very low, meaning we can still continue with higher interest rates and people can still get a job out there and people can rearrange their affairs, meaning they can sell off assets to bring down debt levels and stop their cost of living. So in short, if inflation persists at these levels, when the inflationary target rate from the RBA is 2.3%, 2 to 3%, I should say, 2 to 3%, you'll see further interest rate rises.
Let's look at the other end of the spectrum then, and let's say, end of June going into July, inflation comes back to 5%. Do you think the RBA would be quick to jump on some changes to the interest rate in a negative sense, or would they probably hold to kind of assess where we are?
I suspect in that situation they'd hold for the month. If you saw a shift in 1 month from 6.8% to 5%, I suspect the RBA would hold. The thing that I don't see that scenario happening, although I hope it happens, the reason I don't see it happening is a lot of the inflation is global, so it's being imported into Australia from offshore, which we've got little control over. And there's so many people at the upper end of society, if you like, that are operating in cash that are contributing to the inflation rate, and they're somewhat immune or not impacted by higher interest rates. So whatever the RBA does with rate settings won't, within reason, change their behaviour in the short term.
Yeah, particularly, and I'd assume that end of the market is spending more collectively as well, which is having a greater impact.
Absolutely. The tragedy of this is it's people at the middle and the bottom end of the socio-economic scale that are getting punished by this. So it's the middle upper that are spending the money, but it's the middle lower that are wearing the repercussions of it.
That sounds to me like capitalism working as intended. Look, I'm going to play a dire card here and ask your opinion of what happens if we see inflation continue to rise, rates continue to rise, and we hit the mortgage cliff in a big way, and we start to see some massive, sell-off, distress selling, and those mortgagee sales that you mentioned. What happens to the property market from here? Because I've been doing some reading and, there's so much commentary going around from particularly renters and young people trying to get into the market saying, look, what we need is a great collapse to bring all the prices back down to this nominal kind of level. And as someone who's got a mortgage, I sit there thinking, gosh, that would be terrible because then my asset would be completely worth nothing. And how do I pay off a loan on something that's worth nothing? So I'm interested to see what happens if we end up in this kind of, dire straight scenario where people are forced to sell off en masse, which tanks the market. or may tank the market.
Then you bring the retail banks back into it, a little bit like what you saw during COVID, where retail banks came up with unconventional measures to get people through to the other side. The last party that want to see the property market collapse en masse in the way you've just outlined are the retail banks. So if they don't allow the market to collapse, there's a lot of equity in people's homes to draw back against and let it run till we get to the other side. So there'll be a lot of political pressure on the RBA if we got to that point. And all I can say is let's hope we don't get there, but everything's on the table at the moment.
We've had a little bit of time now with some new federal government in. Obviously, we've talked about that in the past. Given that this is a bit of a precarious scenario, do you think that, the Albanese government are thinking about or trying to plan for any potential mitigation in the event that we do, end up in a bit of a crisis, a financial crisis of our own?
Oh, look, they had the most boring budget on record recently, and I applaud that because they don't want to do anything that creates further inflation. They have done something that creates further inflation by a wage increase for people at the bottom end of the minimum wage of the pay scale. And it's always very, very difficult for anyone to put a good case forward as to why people on minimum wage shouldn't get a pay rise in an inflationary environment. And the public service are pushing very hard for pay rises. And we saw during the New South Wales election that Dominic Perrottet tried to level with the public service, saying, I want to give you more money, but it's just not in the budget and it'll be inflationary and self-defeating. And he lost the election by being level with people. So I think the Albanese government, as far as not wanting to put inflationary pressure into the economy, they're doing a good job. But unfortunately for the government, they're somewhat powerless as to the controlling the forces of global inflation. What can you say?
Final question then, Peter. Do you think that the government has, I'm not going to say a mandate, but a responsibility to keep pressure on the retail banks to ensure that they do their part here? I mean, you mentioned that the retail banks could come into effect if we, entered this kind of dire scenario. Given that they enjoy, in my opinion, just incredible profits year on year, do you think that the government has a bit of a responsibility to ensure that they're not just profiteering off the population in good times and then, hanging us out to dry in the bad?
A strong banking system means that they've got the ability to offer relief when it's called for, say, during a pandemic or during the potential scenario that you outlined. If you look in America, they offered mortgage holders lifetime loans at 2.5%.
Oh, the dream.
It seems like a dream at first until your bank collapses over the weekend, which is what's happened to 4 or 5 banks in America at the moment, because depositors were saying interest rates are now at 5%, I want 5% of my cash, and the banks in America were saying, well, hang on, we've lent all this money to mortgage holders at 2%, we can't afford to give you 5% return on your cash, and the deposit holder said, that's not my problem, I'm moving my money to another bank, and you saw 5 banks and possibly more to come collapse under that scenario. So we must keep in mind the strong banking system in Australia, whilst we don't like struggling on a day-to-day basis and seeing them cracking those sorts of profits, it does mean we've got banks that can support us if we do really hit the fire the way that you've just described.
Well, certainly for myself, and I'm sure anyone listening, let's hope we don't get to that position.
Indeed. Thanks, Ciaran.
Look, thanks, Peter. I'll talk to you next time on Current Market Insights.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate. The podcast providing real estate insights you won't find anywhere else.